Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to properly set expectations for a successful closing. Give us just a moment here to go live on all the different platforms. I see comments already rolling in. Appreciate it. Go ahead and drop a comment there as you tune in. And a great topic here for tonight that Jose is going to go over for us. So it looks like we're live on all the platforms. We'll go ahead and get it started here. What we'll do is we'll take the chat off the screen for now. We'll go ahead and keep dropping comments there in the chat. You can drop any questions you have in the chat as well for Jose, and he can answer any questions after the presentation. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our CSO, Jose Gonzalez. We are a lender that specializes in non-QM loans, and what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is a in-depth loan officer training topic. Tonight's topic is going to be how to properly set expectations for a successful closing. And Jose, with 28 years of experience as closing deals as a loan officer and a realtor, is definitely a master at setting expectations. I'll tell you from all my transactions he's handled, he's definitely the expectation coordinator, making sure everybody is up to speed on everything. So I'll go ahead and let you take it from there, Jose.
And on September 5th, it's going to be 29 years. Oh my God, that's been a long time in the business. So definitely tonight's training is a doozy. I love this one. This is the one that definitely going to come into play now as business ramps up, right? You're going to be getting a lot of those purchase deals, and those are the ones that really put your back against the wall with the time frame, right? You're either going to meet the mark or you're not going to meet the mark. So right there we have our happy couple, right? That mark was met, right? They dealt with the professional loan consultant from the Mortgage Calculator that definitely set the expectations properly, and the end result was the happy closing. The evidence is in the key in their hands. So what exactly are we talking about here? Well, notice there, effective, proactive communication is the key, right? When we're talking about this whole process, this is can be somewhat more complicated than others, but what's definitely going to keep you out of trouble is proactively setting customer expectations helps predict what problems customers will encounter and ensures that the loan officer has a chance to prevent service deficiencies, right? Now, keep in mind the following why. I mean, this is just should be the way you operate your business, right? The most effective way. But notice that there are 340,170 licensed loan officers in the U.S., at least at the time when I did this research. So you really want to differentiate yourself from the masses. And we all talk about being a loan consultant at the Mortgage Calculator and how we like to handle our business. This is definitely the one that we're talking about because rates do not matter much, do not vary much, do not vary much between lenders. Going to be pretty similar, which hence is why professional interaction is critical to building trust, getting the deal, and then closing the deal. So notice our happy MLO there, effectively communicating. So what are the customer expectations? Well, you see there our customer is sitting on a Zoom meeting or whatever other kind of teleconferencing portal or website you use. Our customer sitting there with the loan officer on a teleconference meeting, the loan officer explaining everything to the customer, right? That's a pretty cool one. Customer expectations are a collection of behaviors that customers anticipate from businesses during each interaction. Now, what are we talking about? Well, speed of delivery. And now these aren't necessarily in order of importance, right? We just threw them on there. Speed of delivery, quality, value for money. We always talk about adding value at the mortgage calculator, speed of delivery with our quoting system, right? I could be on the phone with you there while we're talking. I could be sending you 5, 6, 7 quotes in 5 minutes while you're giving me the detail, quality of the work, of the service, of the product offered. Efficient customer service. Make a little note there of Zoom meetings to explain the documents to the customer as we walk them through a tough procedure. For some customers, a tough procedure is just e-signing their disclosures, right? Some of the more technologically challenged people, hey, you can hop in on a Zoom with them. Knowledge and expertise, that's a given, right? They don't want application takers in this very competitive environment. They want loan consultants that can make them feel at ease, that concierge service to walk them through the process. Now, this one blows my mind. I have to put it on here, but answer the phone. Sounds pretty bizarre, right? If you have your phone number in your communications, be prepared that people will call. And some people definitely want to talk, or at least want you to reply to a text, right? So definitely answer the phone. And last but not least, and this is not in the only points that are valid here, but I just throwing down the more important ones. Reply promptly to emails. For example, at our company, we have an SLA of 2 hours or less to answer that email. So our borrower there is very happy because that's definitely one of our mortgage calculator MLOs that are on that Zoom. Now, here's where we're going to start breaking it down a little bit more. Now, manage customer expectations to ensure customer satisfaction. Now, the ultimate goal here is a stress-free experience for our borrower from the loan application to the approval to the closing. And actually, probably starting with the pre-approval, because the pre-approval is equally as important as closing the deal. Because if your pre-approval is not correct, what's going to happen when the customer is under contract, right? He may no longer be pre-approved once the true structure is put on paper. No two mortgages are the same. Hence, you're going to have to react accordingly to each situation. Now, for our loan officers out there, remember, proper training and education will allow you to stand out as a reliable expert. Because if you see the intertwining thread through a lot of the messaging tonight, it's about trust. Building trust allows you to build rapport, allows you to gain loyalty, allows you to be perceived as an expert, allows you to get the deal and get referrals and have a sustainable loan officer career. Find out what the borrower needs and wants for sure, right? That is in that initial interview phone call that you have when you're going over their scenario. That's when you want to break it down and see what the true objective is. Determine the importance of each of the borrower's expectations. Be transparent in your communication, making sure that you're able to fully explain what is going on. Again, being perceived as the expert is what's going to assist you in successfully closing this transaction. Make sure you provide a consistent experience for your borrower, right? Don't be just too extreme. Either you're like always there or never there. Be consistent. And very importantly here, empower the borrower, seller, and realtor by providing pertinent and accurate data. Wow, that one is probably one of the most important ones that we're going to expand on a little bit further. But notice our MLO there with his superhero outfit, super MLO, making sure that they touch on all of these points. So, breaking it down a little bit more on how to empower your borrower so that the proper expectations are conveyed. I like doing this up front in the process before I even get too deep into the pre approval. I like to pre educate all my borrowers, right? You're going to pre educate the borrower with the knowledge that they need and that they require to make an educated decision on everything that you're proposing to them so that they can make sure that what you're proposing effectively meets their expectations. This shouldn't be like you know, forcing somebody down, forcing this whole process down somebody's throat. This should be a process of pre-educating the borrower, empowering them. They have all the information they need to make that proper decision, and the decision should come naturally. It is never going to be a forced decision. And believe it or not, as you're going to see with these additional points here, once you empower that borrower and they're able to make a solid decision, um, compensation is not going to be on the table. In other words, your compensation, they're not going to be looking at ways to cut your comp because you're worth every penny of what you're making. And we don't overcharge because, compensation is preset. So it's not like we can overcharge for anything here, but it's just the perception that the customer gets that can make or break you getting that deal. Now, what are some of the items, some of the topics that we want to pre-educate and empower our borrower on? Well, appraisal. I mean, how important is that, right? All the different facets of an appraisal starting, that could affect an appraisal, right? Value, if it's an investment property, rental income, if it's a non-QM property or an FHA purchase as well, a seasoning on title, right? Seasoning on title by the seller. If it's a cash out refi, seasoning on title by the borrower. The credit score and the effect that it may have on the rate, right? Now we're talking credit score and then getting into that whole credit simulation possibilities and bumping them up, all these conversations that we have when we're empowering the borrower. Once we talk about these factors, then we also may want to talk about some of the program parameters and how they affect the rate and the cost of the loan. Things like, full doc or having to go alt doc if we're a self-employed borrower, or alt doc with the CDFI program if we're primary or second home and we can't go full doc, right? Because the income doesn't qualify, and how that is going to result in a more expensive loan because it's higher risk, right? Higher risk means a higher rate and higher cost of the loan. All of these things that you explain to the borrower, right? It makes everything a lot easier. Adds value to your service. Remember, we want to build the rapport. We want to make sure that they perceive us as providing the maximum value for their money, because this is a transaction that's costing them money. The closing costs are money that they're paying for the services, and they want to get their money's worth. Everybody does. It also is going to lead to a faster borrower decision, right? They're going to know what they should do, not because you're telling them what to do. Many of them will ask you, hey, Jose, what do you think? On which I'm going to break it down based on the data that I provided to them, right? They're going to be happier with the product that was selected, and that's going to result in less of a chance of a fallout, right? That the loan's going to be canceled, or worse yet, that it's going to be denied. Customers don't want to go through with it, but now it can't happen because for whatever reason. But they're going to be happier, faster borrower decision, happier with the product selected, and makes hurdles and obstacles easier to overcome. Now, what I mean by that is, okay, all of a sudden something came up. One of the things that you had explained to the borrower that may happen with the deal, well, we had an issue, when we saw the value, we knew it was a little high. We knew that we would have to have a plan B in case that we had an issue with the appraisal or whatever it may be. You've discussed these things, and now they're ready to take action because you've covered the possible barriers that could mess up the deal. You're going to have that happier customer who's going to be very appreciative of the work that you're doing. And like I have right there, more appreciation of you and of everything that you're doing equals more referrals in the future, because this is not a one and done business. This is about doing repeat business from the same borrower, referrals from the borrower as well. All of that equates to um, greater longevity and sustainability and more happiness overall in your mortgage loan originator career. This also works wonders with investors, because investors, especially, right, they're savvy. They already have experience in this home buying, home selling, home financing process. So they're really data driven, talking about, everything, all the info that you can provide to them so that they can make the best decision possible, all the different configurations of what they want to do that could get them to the promised land, so that they can figure out which is the best option, right? Because at the mortgage calculator, we have over 5,000 options, and many of those are non-QM, and especially with our investors. So believe me, empowering your borrower works wonders. And definitely want to be able to automate tasks and processes to allow you to create a more memorable experience and increase your productivity, right? So, and these are the interactions that you're going to have with the borrower as well, that's going to make you appear a more professional individual, more clearly able to communicate the information through the use of items like a CRM, a quoting system, a borrower portal, and to a lesser degree, your MLO website. So, a lot of stuff going on here where you're sharing information both actively with the customer throughout the whole process, and passively throughout all the additional tools that you have that the borrower may access. And last but not least, you see there who you see there is the happy seller, right? That's the opposite of the unhappy seller who felt abused at the last minute notice that you're not closing today like you thought you were. You were told 30 minutes before you got to the closing. And now, instead of seeing this guy there with that sold sign that he's taken to the next property with him, he's not leaving that sold sign there, and there's the moving truck back there. He's super happy. But the only way that can happen is by properly meeting the expectations of the realtors and the sellers, because that can make the difference between a closed deal, like you see right there, and a dead deal. So make sure to accurately represent your borrower to all other parties of the transaction, right? Do your due diligence to ensure no last minute surprises, especially to the seller if you need to change the closing date, especially to the buyer as well. Come on, let's not abuse the buyers. Inform them. Now, mind you, there are disclosure requirements here. So you do have a fiduciary responsibility to your borrower as to what you can actually disclose. So it's not like you're going to disclose all the details of their loan with, the private information. But if you know you're going to have a delay, if you know there's a delay in the appraisal because the AMC told you, hey, it's going to be 2 weeks before we can get somebody out there to do the appraisal, then and you're supposed to be closing this deal in 3 weeks from today because the borrower was shopping around and came to you when they were already under contract for a few days. Or maybe this is one of those environments where they had a 21-day closing on the contract. That's the only way they could get that contract. So, you got to be on point. And if there is a delay to advise everyone of, you got to let everybody, all the parties of the transaction know. That's definitely not a disclosure issue item where you're going to let them know, I just received notification from the appraisal management company that due to a lack of appraisers in that area, It's going to take 2 weeks for the appraisal report to be received. And the appraisal has to be reviewed, right, by underwriting and checked off on. You can have your file already initially approved, all your conditions in, but you still have an appraisal out there, and if it's an investment property, you may have a 1007, which is a market rent schedule. So those are two big components that could throw a big wrench into your loan if they don't come back with the numbers that we expect, right? So if that's the case, then you want to make sure always inform everybody of any delays, any issues like with appraisal or valuation issues for sure, because they're going to want a copy of the appraisal if there's a valuation issue. Any appraisal underwriting delays, any potential underwriting delays or issues, right? I mean, you don't got to get into the details of exactly what is the document that's wrong, but you do want to, hey, we've had some conditions requested, the borrower's waiting on the documents, and if it's something that you think is going to take a while to obtain, let them know how long it's going to take to obtain the document, because it had to be requested from the employer, had to be requested from accounting, had to be requested from their bank. um, the reason why there exists where there's going to be a delay in the document, and then what's the turnaround time and review of conditions, right? And take it from there. This is all why it's so important when you are structuring your purchase file, especially, right? You take into consideration things like underwriting, turnaround time for initial submission review, condition review, and just initial setup of that file before they start underwriting it. Because those are all things. If you got a super clean file, no issues. But if you got a borrower that's a little iffy with some of the documents that may require additional documents, that's an expectation that you can discuss with your borrower. Let them know we're not going to be able to go with the one that's 7% interest rate. We're going to have to go with the one that's 7.5% interest rate, because their turnaround time is same day. They have a lot of underwriters. We get a lot of extra support, blah, 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 whatever it may be that you need to set straight so that the loan gets off on the correct trajectory, right? You hear me say that a lot. Make sure to communicate any issues or delays with enough notice so that all parties to the transaction can modify their plans with minimal hardship. This is what's going to allow you to not have the deal become a dead deal instead of a closed deal, because now that's a happy seller there, right? Because I let the seller know the delays that we had in time that they could reach out to the movers that they had scheduled, like for the day of the moving of the closing. Like in their mind, they're closing at 9 a.m. There's no reason why they should not have the moving truck and have their stuff out of there by then. Or they're probably already moved out or with the moving truck ready to go, but you have the buyers with their moving truck already packed wherever they're living. And if they're coming from a distance away, they definitely have logistical considerations, and could be a logistical nightmare. But at the last minute, you tell them, I'm sorry, we're not closing on that day. We're going to push the closing back a week. The movers are already like driving halfway across the U.S. to the property, and now you tell them we're not closing today, and you can't move this stuff into the property for like another week. Now they got to talk to the movers. The movers may have to drop the stuff off at some storage location, and then reload the truck again when it's ready to close, and then finish the move. And man, you're talking about doubling the cost of a move, and then possibly having them come to you, if you manage to save the deal, come to you and expect you or somebody to cover this additional expense because nobody told them. If you would have told them with due time, plenty of due time, no issues, no harm, no foul. It's hard. Closings sometimes have to change, and especially if you have a reason in the documentation and you've conveyed that reason clearly with enough time, at least as soon as you were told, then they can plan accordingly. Everybody, the seller, the buyer, the title company that may have to recertify documents, the insurance agent that's maybe waiting for a binder that's going to expire if it doesn't close in the next 2 days, and then they may not be able to bind again for a week or something. So many things come into play regarding communicating with all parties to the transaction, clearly to maintain the everybody up to speed, and clearly have everybody's expectations current to the data and processing and underwriting and all the other facets of the loan. This is probably one of the things that may take the longest, one of the expertise areas that takes loan officers a little bit longer, because sometimes we're afraid or we fear that if we let them know that it's not going perfect somehow or another, it's going to reflect on us. Well, if you cover those expectations up front early enough, or let them know that that may happen, then hey, it's the underwriter review. It's not us, but we let them know, and then we're letting them know clearly now of the issue. Don't hold back thinking you're going to try to fix it without letting them know that there's an issue, and then all of a sudden, if you can't fix it, then you tell them at the last moment, "Oh, I'm sorry, we're not closing today." No, no, you probably knew that 3, 4, 5 days ago or more, and that's when you should have let everybody know. And hopefully, it's your closings aren't so tight like that at the last minute that you're on the edge of your seat, until 24 hours before you close, that you're actually going to close, because that's really tough.
All right. Thank you, Jose. I don't see any questions, so we'll wrap it up. Great presentation there, though. Remember that we do this every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern, where we do a new loan officer training topic. So we will see you all tomorrow, 7 p.m. Eastern.